Welcome to our penultimate presentation for Chapter 3. That's a fancy word for second to last. And in this presentation, we're going to take a look at the different types of common stocks. Uh, People often think that all stocks are the same. Oh my goodness, no, nothing could be further from the truth. And then we'll end with the computation of market capitalization. In other words, how big is the company? So get out that study guide or however you take your notes, because these uh, these types of stocks are just generalizations. Some companies fit neatly into one or more categories. Some companies don't fit neatly into any category. So we're going to see the major categories of companies, and much of this is paraphrased from Peter Lynch's book One Up on Wall Street, where he talks about the different types of stocks and how you should uh, think about investing in them. So make sure you read One Up on Wall Street eventually, not right now, relax. Okay. Our first type on slide number 34 are the blue chip stocks. Now, where does the term blue chip come from? It came from the gambling tables, if you can believe that. Because over 100 years ago, 200 years ago, the hoi polloi did not invest in stocks. No, it was only gentlemen, very rarely, sometimes a woman, but gentlemen. And what gentlemen also did is they went to the gambling tables. And the gambling tables, the blue chips were the most expensive chips. I don't think that's true anymore. So these are the biggest companies. These are the brand name companies that have been around for decades. So let's read together. Financially strong, high quality stocks with long and stable records of earnings and dividends, often growing their dividends. Now, excuse me, you will sometimes hear people talk about these stocks as value stocks. Well, hang on a minute, because we're going to discuss this term that people use in the industry for value. It attracts conservative investors. Now, this has nothing to do with politics, folks, not liberal versus conservative. No, it means investors who do want to invest in the stock market, but are not interested in the next greatest thing that may explode or may implode. So examples of these are companies that you've all heard of: Exxon Mobil, Johnson and Johnson, right? And now many people are including some of the major tech companies that have exploded beyond any wildest valuations and capitalizations. But if you think of the stalwarts, this is what Peter Lynch calls them. He calls them the stalwarts. And the next category are income stocks. Now, sometimes blue chip stocks are income stocks, sometimes not. But income stocks are generally regarded as stocks with long and sustained records of paying higher than average dividends. And again, some people will often refer to these as value stocks. They are normally slow growth companies in mature industries. So the poster children for income stocks are utilities. Are utilities growing quickly? Well, if the area they're in is growing, then the utility has to grow. But generally, no. But do people want to all of a sudden start taking cold showers in the dark? No, they want to cook their food. They want their water to be warm. So utilities are very reliable sources of income. And the banks. For decades, banks have been boring income stocks until they got exciting in the late 90s and the 2000s, and we had the global financial crisis. And we can say with some degree of accuracy that banks have become boring again. Now, every once in a while, there's an issue in the industry, and right now, people are worried about commercial loans, commercial real estate loans, because a lot of people have left the office. But still, banks are the backbone of a modern economy. You can't run a modern economy without banks. So they're not going anywhere anytime soon. And they tend to pay pretty good dividends, but not always. Now, slide number BUS125. Growth stocks are stocks that experience high rates of growth in operations and earnings, growing at 15 to 20% a year. And that might not sound a lot, but if you were growing at 20% a year, in 3 years, you'd be twice as tall as you are now. They're often associated with high price to earnings ratios, right? So the more growth there is, the more people are willing to bid up the price relative to the earnings. And usually they're not paying dividends or maybe a small token amount. Why? Because they need those earnings, those profits to be reinvested in the company. Now, we expect that the stock price should go up, but it will usually be very volatile. So what are some of the examples? Intel, Dell, HP. Wait a minute. Are Intel, Dell, and HP still growth stocks anymore? 20, 30 years ago, they sure were, right? But not so much anymore. They've become mature companies that are more cyclical. Who are the growth stocks now? The stocks that are on the cover of GQ and Vogue and Vanity Unfair. They've got the beautiful teeth and the $200 haircut, and they've worked on their abdomens. And Apple, Google, Microsoft now is another growth stock that has reinvigorated itself from the early days of the personal computer revolution. Nvidia, the Magnificent Seven, they're calling them now. I hate it when you hear jingoistic terms in the investment world because it usually ends badly. Not always. So these are the companies that people are talking about. They're always discussed. Will they go up? Will they go down? I like boring old companies, but these are the growth stocks. Now, the next before we continue, I'm sorry, I meant to remind you of this. Growth versus value. The investment world loves to throw around the terms growth and value. And you're going to hear people discuss, oh, it's a growth stock, oh, it's a value stock. But the meanings of the terms are not exact. Typically, investors will use growth to designate a high PE stock, while they use value to denote a low PE stock. But wait a minute, that's not the way I think of the word value, and I hope you think of the word value. A high PE stock may be a good value, a great value. A low PE stock might not be a good value. I think of value, I think there's something attractive there, something that piques my interest and might help either grow the capital, meaning the stock price goes up, or pay good dividends or grow the dividends. Here's a perfect example. In January of 2005, Google, which was selling for around $200 with a sky-high PE, I think it was like 68, while the old GM was selling for $34 with a very low PE, I think it was like 5 or 6, and a huge dividend. They were paying very good dividends. Well, at the time, I kept saying, this is not right, GM. They weren't making money off of their cars. They were only making money off the SUVs and the trucks. It's not a good sign. And sure enough, they went through bankruptcy. Google now sells for over $6,000, split adjusted with a much lower PE. And the old GM stock, which was first named Liquidation Motors, and GM got really upset about that, so they changed it to Motors Liquidation, which kind of sounds silly. It last sold for 4 cents in March of 2011, and that stock is now worthless. So, which one was the better value? You see what I'm trying to coax you into thinking? Just because a stock has a low PE, paying great dividends, doesn't mean it's a great value. Just because a stock has a high PE, not paying any dividends, doesn't mean it's not a great value. So be careful, because you're going to hear people throw out the terms growth and value, and often what they're describing is high PE versus low PE. Price to earnings ratio, very subtle. We'll discuss it in detail throughout the rest of our journey on stocks together. Slide number 77. Now, this is a category that is often lumped in with growth stocks, But often speculative stocks are not making any money. They're losing money. They haven't made any sales maybe yet. These are companies with a high degree of risk. They are typically losing money or have a very low earnings, have very low earnings relative to their valuation. They offer the possibility of substantial, some might say astronomic capital gains, or more likely substantial capital losses. Biotechnology, internet-related stocks in the 1990s, late 1990s, alternative fuels, marijuana, now artificial intelligence. I don't like that. That's too close to home. Artificial intelligence. Anybody want to buy Robinhood, AMC, or GameStop? These were the AMC and GameStop were called meme stocks for a while. Well, before you do, take a look at the history of GoPro, which has a pretty cool little product, don't they? The cameras for very people who love adventure, and you can take it under the water and jump out of airplanes with it. And one of my students several years ago was really gung ho on GoPro. And I would say to him, I said, it's a camera. At its heart, it's a camera. Right now, it's very concentrated in what it can do, very specialized in what it can do. But lots of other people are making cameras. How come, Canon and Nikon? How come Apple and Samsung are not selling them? And it turned out that once everybody who owned a GoPro was going to buy a GoPro, a small market, their sales plummeted, and so did the stock. It gives us yet another opportunity to trot out Mr. Benjamin Graham's wonderful definition of what an investment operation is. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. So go ahead and buy a speculative stock. But how about this? For every one speculative stock you buy 4 boring blue chip income related stocks, companies that have been around for decades, right? You decide. It's your money. Slide number 78. Now, you're going to hear people say, oh, that's a cyclical company. That's a cyclical stock. What are they talking about? It's round? No, it has nothing. No. Cyclical stocks are stocks whose earnings and overall market performance are closely tied to the general state of the economy. They follow the business cycle of advances and declines. And the poster child for cyclical companies are automobiles. When the economy is forging ahead, wages are rising, there's plenty of employment, what do people do? They go out and buy a new car. What's wrong with the old car? I want a new car. I like that new car smell. What happens when the economy hits the skids? There's a recession. People are losing their jobs. Yes. Old Bessie in the driveway is doing just fine. Thank you very much. So car companies, when the economy is doing well, they make tons of money. And then when the economy is doing poorly, they lose tons of money. So you can watch it. You can watch it just go up and down with the cycle of the economy. And it turns out that any company that makes stuff like timber, steel, chemicals, and now chips, because everything that you make, everything that is made has a chip in it somewhere. These are cyclical companies. Transportation, leisure, they follow the business cycle. They're going to do well when the business cycle is doing well, when the economy is expanding rapidly, and they're going to do poorly when the reverse is true. On the other side of that coin are defensive stocks. Now, we're not talking about companies that make bullets or tanks or jet fighters. We're talking about companies that tend to hold their own or even do well when the economy starts to falter. What companies would do well? Well, think about it, folks. They are companies that make things that you need no matter what. Do you eat more Cheerios or cornflakes because the economy's doing well? Do you eat less Cheerios or cornflakes because maybe you buy the generic brand, but you still got to eat? Same thing is true with diapers, Procter and Gamble, or soap or toilet paper. Drug companies, somewhat, but they have their own cycles with new drugs and old drugs and the like. So you will hear people say, oh, the economy is starting to falter. Investors are rotating out of cyclical stocks into defensive stocks. You'll hear talk about sector rotation. Now, I'm not personally a big fan of them. I like to hold companies when it makes sense to hold companies and sell them when it doesn't make sense to hold them because you decided that their future prospects are not that great. So what some people will do is the reverse. They're called contrarians. We'll talk about that strategy in a little bit. When the economy is doing really, really well, they might sell their cyclical stocks and buy more defensive stocks and basically do the opposite of what the crowd is doing. But do you understand the difference between cyclical and defensive? Yeah, I think so. In fact, during 2000 to 2002, the defensive stocks really took it on the chin before the downturn in 1998, 99, 2000. They were considered old economy stocks. But then they actually did well. They went up in 2000 2001, 2002, when people realized, yeah, these companies, people are going to continue to eat Cheerios and cornflakes. Now, the next slide has a few of the sort of off the beaten track type stocks, turnaround stocks. These are companies that have fallen on hard times. And what you have to ask yourself as a potential investor, is there a potential for a rebound? I tend to call them goners because they usually, but not always, don't turn around. They're down. They're kicked down for a reason. But many people weren't even born. Many of you weren't even born yet. But in the early '80s, Chrysler almost disappeared. Their cars were just suffering from such bad manufacturing and reliability that the company almost went bankrupt. And a gentleman by the name of Lee Iacocca, you could read his autobiography. I could read plenty of stuff about him. He was the gentleman who actually was the project manager who brought the Ford Mustang in the 60s to fruition. And there's a car that's still in production, very popular car. And then he took over Chrysler at its nadir, at the depths of when it was about to go bankrupt, and turned it around. So the stock went from about 40 something, 47, 48 down to under $3. And then he turned it around and went back up into the 40s. AMC now, they really, really took it on the chin with the COVID pandemic because you couldn't go to the movie theater. And then it turned into what some people call the meme stocks, where they were just trading it. But the AMC is trying to come back, and we'll see. A lot of people have been predicting the demise of movie theaters for decades, since VHS cassette tapes came out. And, they seem to be holding their own. I don't follow them that much. I don't typically go and sit in the dark and watch a flickering light like a lot of people do. But that's up to you. You might love movies. You might love the movie industry. And so do research AMC and see if they're going to come out of the funk that they've been in. The next category are asset play stocks. These are companies that are sitting on an asset that could be sold or spun off. For example, JCPenney's, a venerable company, started in 1903 or something like that. They owned an insurance division that was very profitable. They sell you insurance that you don't need, and people buy it. So the department stores, the mid-sized department stores, many of them are gone, like Montgomery Ward's and who else? There's tons of them that have disappeared. And the ones that are remaining are really having a tough time because they're getting hit from the bottom by the Targets and the Walmarts of the world, and they're getting hit from the top by the boutique stores. But JCPenney's is still in business, and they were able to sell that profitable insurance division to keep the company afloat. Here's another example, a wonderful example of an asset play. Who owns Frito-Lay? Hmm? Hmm? Oh, I'll let you figure it out. In fact, I'm pretty sure, I haven't checked lately, but I'm pretty sure the company that owns Frito-Lay makes more money off of Frito-Lay than they do off their signature product. And they used to own, what is it? Kentucky Fried Rat, Pizza Crap, and Taco Smell. I'm sorry, Kentucky Fried Chicken, Pizza Hut, and Taco Smell. So look at that. Because asset plays, you have to do a little bit of digging. You have to go look under the hood and see what assets are on the books of the company. And then penny stocks, folks. Stay away. Don't get. We've already talked about how. Well, if you've listened to the discussion of bid versus ask, and then looked at the casas de cambio, you're just you're on the wrong side of the tracks. You're in the bad side of town, the red light district. It just stay away from these companies. They're not real companies. They are scam artists. And so there are many examples in Canvas and on the class website. So check them out. Somebody wants to sell you a stock that's only selling for 7 cents. Just stay away. And those, where are they? Right, they're on the pink sheets, now called the OTC markets and the bulletin board, the OTC bulletin board. Lastly are foreign stocks, called international stocks, also called overseas. Traditionally, they were difficult to transact, difficult to purchase, difficult to sell. But now there are many brokerage firms that have international accounts. What does that mean? It means you can you place dollars into these international accounts, but then you can move your dollars to other currencies, to Mexican pesos, to European euros, to Japanese yen, and you can buy and sell the stocks on the exchange in Tokyo or Mexico City or Frankfurt or London. So, and many people do. Many people do that. In fact, the brokerage firm that I'm associated with, that's their bread and butter. Is they're mostly most of the brokers are either of Mexican. One guy's from Spain, and the president is actually from San Diego, but he lived and worked in Mexico City for many years. So they started that several years ago, but now the big boys and girls are doing it too. But for those of you who don't want to move your dollars to other currencies, you can find companies that are American Depository Receipts, ADRs. You'll also see GDRs and DRs, Depository Receipts. Now, what's going on here? I think I made mention of it in the discussion in the presentation of how to look up stocks on the internet. For Sony is based in Japan, right? You want to buy Sony, you could change your paid dollars into yen and use one of these international accounts and buy it on the Tokyo Exchange. Or what somebody in New York typically has done, a bank or a trust company, they've gone over to Japan and bought a ton of Sony or Toyota or Honda and brought it to New York and then reissued it dollar denominated. And so you don't have to worry about moving your dollars to yen or pesos or euros or whatever. So that's very cool. Now, I wish some companies like Nestle would do that, but it hasn't done yet. And of course, many of us will use global and international mutual funds. Why? Because the mutual fund companies just have, tremendous resources. They have people based all around the world, knocking on doors of companies all around the world, speaking many different languages from many different cultures. So for the vast majority of us, unless we stick with big companies like Toyota, it's not a good thing to do, in my humble opinion. And the currency issues. When you move your dollars to another currency, you have to be aware of the currency issues. Now, They shouldn't be, in my humble opinion, the tail that wags the dog. But it's an inverse relationship. If you have a stronger US dollar, that has a negative impact on your investments overseas. Huh? Right, because now you need more of that currency to buy back the dollars. But if the dollar goes weaker, that has a positive impact. And some of you maybe have relatives in Mexico, you visited Mexico, so you've experienced this. When the dollar's strong, you go over to Mexico and oh boy, you can buy a whole lot more for your money. When the dollar's weak, it's the exact opposite. But think about it. If you had purchased that house or whatever in Mexico and the dollar gets stronger, well, now you need more pesos to buy back your dollars. And the opposite is true. If the dollar goes weaker, now more pesos will buy more dollars. So it's called an inverse relationship. And so we have to think about those. In my humble opinion, the dollar has been too strong for too long, and I'm expecting it to moderate. I don't want to use the word crash. Some people are using the word crash when they talk about the BRICS, and that's a whole other issue. We don't want to get into it, but when we talk about people wanting to de-dollarization the world, all I can say is it's about time. After World War II, we were the only people standing after World War II, and we had to rebuild also. So it made sense for the dollar to be the world's currency reserve. But that was 70, 80 years ago, folks. Many other economies are much stronger. Their currencies are more stable. So it makes sense for us to share the duties of having a currency that is accepted all around the world. I think so. I think it ultimately is best for us, too. It's just a strong currency is a blessing and a curse. It will make our companies more competitive. It'll make us more competitive as workers. It will cause some disruption. That combination ice crusher and MP3 player that you can get at Walmart for $29.95 might be $59.95 or $89.95. But do you really need a combination ice crusher MP3 player? Think about it, folks. Slide 81. Okay, so we're going to turn our attention now to market capitalization. So time to stretch and pause if you need to. Because market capitalization is the most important number when we think about price. Many people will concentrate on the price. It's $80. You think it'll go up to $90? Forget about the price until you get into the penny stock world. What's more important is the market capitalization. It's a very simple calculation that we'll do once or twice, all semester long, because all you do is look it up. There are three major categories: large cap, mid cap, and small cap. Do you remember these from mutual funds? Right. The Papa Bears, the Mama Bears, and the Baby Bears. Now, it used to be, just for a few decades, that $10 billion and up was large cap. Now you're hearing people say, oh, it needs to be at least $15 billion. Whatever. I'll use 10, 2, and under 2. I'll use the ones that are highlighted, and the smaller ones you can use if you want the ones that are in smaller fonts you could use. Once you get above $100 billion, folks, you're in what's called the mega cap subcategory of large cap. So either one. If you want to say large cap, say large cap. If you want to say mega cap for the big companies, the Apples of the world, the Googles, the Walmarts, the Exxon Mobils, and the like, go right ahead. It's up to you. But I'll take either. They're both right. Mid caps used to be around $2 to $10 billion. Now you're hearing people say, no, it's mid cap. It's got to be at least 5 or 6, up to 15 billion. So either one is up to you. Either one is up to you. And then small caps used to be around 100 million to 2 billion. Now you're hearing people say, oh, your small caps are up to 5 or 6 billion. So again, it's up to you. Now, there's a subcategory of small cap called micro cap. And that was, under 100 million. But now you're hearing people say, oh, up to $400 or $500 million for a micro cap. So It's fluid. It's squishy. And so you decide. But these are the ones that we'll use. And I'll use. You can use your others. I'll take them. I'll take them definitely. I won't say they're wrong. It's just there's a difference of opinion. Now, as we've said, there are certain stocks that shouldn't be mentioned in polite company, and those are the penny stocks. The industry will say that anything between $1 and $5 shares is a penny stock. Yeah, I tend to get people. I want people to concentrate on the ones that are selling for 0.07 cents or 3 cents or whatever, because those are the real scam artists. Some companies that are under $5 a share, they might just be a hit on hard times. It doesn't mean we should invest in them, but they are going concerns, or maybe not so going concerns. But they're not trying to scam you. They're trying to make a go of it, and maybe not succeeding, and maybe failing. So, but just realize it's kind of like when you say art. I know it when I see it. Well, it's the same thing as penny stocks. They're scams. I know it when I see it, and hopefully you will know it when you see it. You'll see a company that used to be making mattresses or something like that, and now they're making marijuana or selling marijuana or whatever it is. Just stay away from them. So here's an example. The stock is $20. The price. Is it a large cap, mid cap, small cap? We don't know. We don't know until we know how many shares are outstanding, are being traded. And in this case, there's 5 million shares. So if you take 20 times 5 million, you get 100 million. And there's a worksheet that we want you to go through, worksheet number 3, that does a few of these calculations. They're very straightforward. 100 million, right, this is a small cap stock. Some people might say it's a micro cap stock. So either one is fine. Now, is it a mid cap or a large cap? No. So that would not be correct. And no, $100 million sounds like a lot. It is to you and me. That's a lot of money. But in the world of publicly traded companies, this is a very small company. And read, the stock price, for the most part, until you get down to 7 cents, is irrelevant. You must look at the market cap to see the value of the company. Remember Warren Buffett's Berkshire Hathaway? Right? The price is not important. It's the valuation, the capitalization. Okay, so now let's take a look at some examples of capitalization. Let's take a look at Walmart, Costco, and Target. So here's 3 little mom and pop shops that you may be familiar with. And looking at the prices, whoa, wait a minute. Walmart's the cheapest one. That doesn't make any sense. Costco's expensive, and Target is a lot more than... No, you're looking at the price. The price is irrelevant. Earnings per share for Walmart, $2.42, $17 for Costco, and $9.44 for Target. But when we compute the price to earnings ratio, take the price divided by the earnings, it turns out that Walmart has a PE of 40, which is pretty high. Costco's even higher, 56.5, and Target is 14.8. So what are investors saying with their dollars and the willingness to buy the shares at these prices? They're saying they're far more excited about Walmart and Costco than they are Target. Now, are they right? 3 years from now, we'll know, but that's what investing is like. We don't know. I mean, if Costco doesn't continue to do what they're doing, which is pretty amazing, folks, Costco is like a cult. People go in there and you're not allowed to leave without spending at least $300. That's why they check your receipt at the door. If you haven't spent that much, they send you back and buy more stuff. But Target investors are not too happy about the future of Target. We'll see. Looking at the book value, we see that all 3 companies' stock price is far higher than the book value. Well, that makes sense, doesn't it? I mean, think about it, folks. A pizza shop. I mean, really, what are the assets worth in the pizza shop? The oven obviously is expensive, but all the utensils and the plates and the tables and chairs are really. The company is worth far more than the assets on the books because it is earning money. And that's true for companies with lots of zeros next to their market capitalization. The dividends per share are 83 cents for Walmart, $4.64 for Costco, and $4.48 for Target. So Walmart and Costco are not paying very much as a percentage of their price, 0.99%, 1% is what you're getting from the dividends in Walmart, 0.5% for Costco, whereas you're getting almost 3% for Target. Now, again, that's a reflection of what investors think is the future of these companies. They're far more excited about Walmart and Costco than they are about the future fortunes of Target. I mean, Target ain't going away, folks. But folks, Target is still only in the United States. Walmart and Costco are global entities. In fact, I love to tease people who are frightened of Mexico and Tijuana. I say, I'll take you to Tijuana. I speak Spanish pretty well, and I'll show you some of the best places to eat. But don't worry, we're going to visit the most dangerous place in Tijuana, North Tijuana. But we'll go there in a day, don't worry. And you drive across the border, and 30 seconds, you're in the Costco parking lot. And they go, this is a Costco. I say, yeah, you want to see the Home Depot? How about the Carl's Jr. or the McDonald's or the Kentucky Fried Chicken or the Applebee's or the Smart and Final? Yeah, right. So Target tried to move into Canada, and you would think they would have done a good job because they're based, I think, in Minneapolis, right? They're based in Minnesota, but no, they got clobbered and had to give up. So investors are far more excited about the prospects of Walmart and Costco than they are for Target. And that's what the investors are saying with what they're willing to pay. Starting to make sense? It's not that hard, is it? I don't think so. Intellectually, emotionally, because people are making a big bet on Costco. They're making a pretty big bet on Walmart. And if those bets don't turn out, the parachutes had better be very, very large. Now, let's take a look at a few companies that you may have heard of. AT&T, Verizon, and T-Mobile. The duopoly, AT&T and Verizon, and then the upstart, T-Mobile. Again, oh my goodness. I mean, is T-Mobile... what's going on here? $24, $40, and $235 a share? Again, price is irrelevant. You must look at we forgot to look at oh my goodness, we forgot to look at the market capitalization. Look at the market capitalization of Walmart. Talk about a mega cap. And look at the market capitalization of Costco, $400 billion. Costco is still worth about half of what Walmart's worth. And I think that's the reason why many people are really excited about Costco, because they're thinking it's going to be worth as much as Walmart. But look at the capitalization for Target. Ugh, $64 billion. It's no shabby company, folks. $64 billion. I mean, if you wanted to own Target, you'd have to have $64.2 billion in your pocket, walk on down to the New York Stock. That doesn't work that way. Actually, when one company wants to take over another company, there's a set methodology, a process. Because if all of a sudden you started buying all the shares at whatever price to buy all the shares, the price would just start skyrocketing and people would go, what's going on here? So there's a methodology called a tender offer, where you go to the New York Stock Exchange and you say, look, we have, $60-some billion. We want to buy Target. Well, what they would ask you to do, they say, well, you got to offer more than that. You got to offer about $70 billion, usually about 10 or maybe 20% more. So they would set a price target of about $155. Now, they announce that at a certain time, and if the folks doing business with their shares, with Target shares, and investors believe that it is a real offer, a bona fide offer, then the price will skyrocket to that jump to that takeover price. If people believe they're just blowing smoke, they have no intentions, then the price won't do that. If they think another company is going to want to go in and raid the company and buy the company, it might go above that tender offer price. So it gets really tricky. And can you imagine there's all kinds of opportunities for hanky panky? Yeah, one time as a joke, Elon Musk said he was offering $420 for it was like 370 or something like that for Tesla to take it private. 420 is the number associated with marijuana. He got fined $20 million. Tesla got fined $20 million. He had to pay the fine for Tesla, so he was out $40 million. But I mean, he can afford a $40 million joke. This was several years ago. So yes, look at the market capitalization. Target is worth far less than Walmart and Costco. Now let's take a look at our three communications companies. Look at the prices, and it looks like T-Mobile is worth a whole lot more. Well, it turns out T-Mobile is now worth more, but we'll see how much more. Not 10 times or 20 times more. Earnings per share, $1.49, $4.14, and $8.78. And so the PEs for AT&T and Verizon are, not too shabby. 16.3, 9.73. People are more excited about AT&T than they are Verizon. But the PE for T-Mobile is 26.8, which means investors are more excited about the prospects for T-Mobile than they are for AT&T Verizon. Now, are they right? We'll see in 2 or 3 or 4 years. Book value, again, less, but not that much less. Not like it was for the three retailers. $14 as opposed to a price of $24 for AT&T. $22 as opposed to $40 for Verizon, but far less with regard to T-Mobile. So you see, investors are kind of more excited about T-Mobile. Dividends per share, $1.11, $2.71, and $3.52. But on a percentage basis, AT&T is paying almost 5%. Verizon is paying almost 7%. That's more than bonds are paying, the Verizon bonds. Whereas the T-Mobile dividend is far less attractive at 1.6%. It's another reflection that investors are not so excited about the AT&T and Verizon's future prospects for capital appreciation. They might buy them for the dividends. I mean, 5%, 7% is not too shabby. But remember, that dividend is not guaranteed. Next quarter, either of those companies could say they're not going to do that. They're going to continue to pay dividends because they got a lot of cash coming in the door. But T-Mobile's is only 1.6%, which is yet another reflection of the fact that investors are more excited about the prospects for T-Mobile than they are for AT&T and Verizon. And look at the market capitalizations. Now, look, they're all mega cap companies, right? Everybody's got to have a cell phone these days. So AT&T and Verizon are similar, 174 billion, 170 billion, but T-Mobile, 270 billion. Right, and T-Mobile started out at much less and has now surpassed it's actually still smaller in terms of how many people own that, how many subscribers, that's the term, subscribers they have. But it's definitely playing catch up. Cool? So what do you think, huh? Yeah, I think it's pretty amazing. Now, what's the difference in this dividend yield versus a yield from a bond or a savings account? Right. This is not guaranteed. That dividend yield is not guaranteed, and the stock price could fall. Right. So yeah, you're getting paid a lot of dividends, but you'd be losing capital gains. So again, there's a lot of moving targets here. What do you think? Now, in the assignment, we ask you to go and check some of the data, this same data that we showed you here, to use Yahoo Finance or CNBC or MarketWatch or Morningstar or whichever one you find cool, or go to the library. And also, we want you to work on worksheet number 3, which will do a few of the calculations, the market capitalization calculations. But again, once you do a few of them, you don't have to worry. I mean, there's one on the exam. There'll be at least one on the exam, but you just go look it up. Cool. All right. Think about how much you've learned. We're so proud of you. Now we're ready, finally, for our last presentation with regard to Chapter 3, with regard to Introduction to Stocks, and that is the different types of stock investment strategies. Thank you so much again for being in our class. You are awesome. You are rising investment gurus. We are so proud of you, and we'll see you in our last presentation.